Hello, my name is Jon Meyer. I head up the wealth management team here at BGM. And today I'm going to be talking to you about tax planning for investments in retirement. Most of this will be geared towards individuals, but there might be one or two pieces in here that business owners might be appreciative of as well. Before I get started, I want to just remind you on your toolbar, there is a Q&A button. If you want to submit any questions along the way, feel free to do so. I have the box open on my computer, so if you do, I'll see it and we'll stop and answer whatever I can along the way. With that, I'd like to get going because I do have quite a few things today to share. So if I could start with our standard disclosure, just to remind everyone that everything I talk about today is generic in nature. So I will share some ideas and strategies that we typically are working on with clients. Sometimes though, I want you to be careful and go seek further help from another professional or us if you want, because we are going to talk about things that if people do on their own, they might not make the exact moves that we're talking about today. So please make sure you talk to a professional. As I get going, today's agenda is geared towards a few things. I'm going to spatter throughout some ideas. So there isn't like one slide that says, here's all the good ideas. So today I want to start with a summary of what the Secure Act 2.0 did. That was a law that was passed in December of 22 that took effect January of 23 and how that's impacting us. I'm going to then jump into some general IRA issues, required minimum distributions, get into what's going on within certain tax brackets. So I'm going to spend a lot of time in some detail on a couple of slides and then a few other interesting ideas around gifting to charities, what happens with Social Security. And for the business owners on the line, I'll touch at the end a little bit on a couple of other ideas. But for the most part, this is going to be geared more towards families that have investment and retirement goals. So let me start with what's going on with Secure Act 2.0. As I mentioned, we've only had this around now for about a year, but what it did that was really big is it changed the required minimum distributions for us. For those of you that may not be aware, required minimum distributions occur and are mandated so that whatever money you have in an IRA or 401k has to start coming out at a certain age. Well, that age used to be 70, and then it changed to 72. And now in 2023, they changed it to age 73. 10 years from now, that increases to age 75. So what that's really doing is pushing out when you have to take taxable income. And the reason that's important is because sometimes I'm going to get into this in a little bit. I'm going to talk about some strategies where we want to actually increase taxable income in years where you have lower tax brackets. The problem with required minimum distributions is once you start them, you end up in higher tax brackets usually. So I'm going to get into that. The second thing it did, though, is it took away required minimum distributions on Roth accounts when it's Roth 401ks or Roth 403bs. We've never had these required minimum distributions on Roth IRAs, but they were technically there for Roth 401k and 403bs. That is now no longer the case. So that actually makes those a little more interesting. It did change the catch-up contributions for retirement plans. So it added a new layer. We've always been able to do 50 and older, and that number gets indexed up for inflation, currently 7,500. But what it added was a new layer. So if you're 60 to 63, and this starts in January of next year, you can actually do $10,000 more. So there is a little bit more coming your way if you're a little bit older. And that's a new part to this law. You know, sometimes what we see when laws like this get passed is that that's a starting point, and in the future, they may change that to expand it, maybe 60 to 65 or something. But for now, it's 60 to 63. And the last big thing it did, and I'm talking just about the big things that this Secure Act 2.0 did, is it did change 529s a little bit. So what it did is it basically said, if you overfund a 529, and plenty of people have, especially if you're putting in a chunk of money for your grandkids or something, um, they don't spend it all. Then what happens? Well, in the old world, the answer was you'd have to basically take that money and either change, add a new beneficiary, or you would turn around and um, just take it out and take the 10% penalty and pay the taxes. But what they added now was this new idea that we're going to let you roll excess funds into a Roth IRA for the beneficiary. Now, there's some rules around that. First rule is the most they're going to let you do is 35,000. And the way that occurs is at the limits, the Roth IRA limits each year based on income limits. So, we're going to be able to do this, let's say at current levels, it'll take about 6 years to do that. Roughly 7,000 times divided 35,000 divided by 6 is about where we're going to be. You can't just do it 35,000 right away. Secondly, that beneficiary has to have earned income to do that. So, it doesn't work to just say, well, I'm just going to roll this over because they're 20 years old and I'm not going to need it. They need to have earned income for those. So they kind of have to by standard qualify to do a Roth. And the third thing is this Roth account has to be, or the 529 money will have had to be in the account. The 529 will have had to be open for 15 years for this to be eligible. And the second part to that is any dollars that were contributed to the 529 in the last 5 years don't count. So what this is really going to do then is it's going to benefit people that kind of front load 529 plans as opposed to backloading them. So I think the more we get in on the early side of a, when the baby's first born kind of thing, that's where we're going to see some benefit. I don't see this as an earth-shattering opportunity, but I do see this as an interesting opportunity for people that want to maybe give their children or grandchildren a leg up in the next years going forward. So just know that that's out there. Interesting idea. Now, I want to switch gears a little bit and talk about things based on where taxes are at. So this is I'm going to step back a little bit. When we talk about investments, what I think people kind of forget is that returns are really gross return minus fees, taxes, and really inflation. So in the past couple of years, if you think about it, even if we're getting double-digit returns in a year, inflation's been higher. So you in effect earn less. In this example, I just simply show that if we have a 7% return, it really isn't 7%. If you have 12% tax rate on that 7% versus a 22% tax rate, at 22%, your taxes are 83% higher than if they were at the 12% rate. And I don't think enough people think about returns in this manner. So when we talk, we're trying to talk about returns net of fees, taxes, and inflation. I bring this up because this is going to become a bigger issue as you think more about what retirement actually means when people start thinking about the 7% number or 8% or whatever you're thinking about for retirement. Because at the end of the day, you probably can only spend 3 or 4%. The rest gets eaten up with taxes, fees, and inflation. Now, when we think about taxes, what I'm showing here is a rather complicated graph. It basically is showing you where the income tax levels are. So if we follow just the first column, taxable income for a joint taxpayer, and today I'm going to talk about joint taxpayers. If you're single on this call, feel free to follow those columns. But for the most part, on the joint column, what we see is an income, let's say up to 94,300, which is right here. We're going to basically be paying taxes in the 12% bracket. Now, what's important to understand is as you go from bracket to bracket, it doesn't jump to the next one on all your money. It just jumps to the next one on those incremental dollars. So on the next chunk from 94,301 up to 201,000, those dollars are at 22%, but the first chunk is down here at 12, and really the first 23,000 comes in at 10. Now, this is important to understand because what we're going to talk about a little bit sometimes here is maxing out certain brackets where, let's say your income came in at 50,000. Well, we know we can go up to 94 in this 12% bracket. So if you're only at 50, maybe we should talk about pushing 40,000 extra into this column because we know we're only going to pay 12% on it today. But down the road, when you start those required minimum distributions, along with Social Security or whatever else you have going on, maybe you push yourself up into this bracket where you pay 22% on that money. So this idea of maxing out brackets becomes a much bigger planning tool. Usually when people talk about taxes, they talk about minimizing taxes. And what we try to talk about is optimizing taxes, because there is an optimal answer that typically when you look out over a 10 to 20 year period, you're going to optimize in lower brackets on average. So that's a big thing to pay attention to. Second piece to this is, and what happens with all these extra things. So there are extra taxes for Medicare surtax and other things going on that can add on top of that. And so you really have to pay attention when you get into these higher brackets, what's going on, because there are times where we can maybe push the numbers down into a lower bracket for specifically avoiding some of these other issues. That's about as much as I want to say on that part of it, but just know that that is an opportunity there. The second piece to this then is capital gains. So those brackets are a little simpler for capital gains. That first $94,000 number, though, is interesting because when you only go up to 94 as a joint couple, you basically from 2017 on paid 0% capital gains. So from the standpoint of when the law changed, basically it's interesting now. We can sometimes, if people are in very low brackets, sell assets, take capital gains hits for whatever reason, get them in at nothing. On the next basically $500,000 though, we can get it in at 15%. And then after that is when they jump to this new 20% bracket that started back here. With this, there's also this Medicare surtax issue. So there's another 3.8% added on to capital gains when we hit in these other brackets. I bring that up because that can become problematic too. Now, these 3.8 doesn't start right in this bracket. If you go down to my notes at the bottom, you'll see that those surtaxes kick in for filing joint, married filing joint at 250,000 plus. Just the way I have this slide set up, I kind of had to slide it in somewhere so I remember to talk about it. But in essence, there are other scenarios where these things kick in. So I just want people to be aware of that. Finally, when you come back to Minnesota, and I did this slide because I do know that a lot of people on this call are based in Minnesota. So if you're not based in Minnesota, this will vary obviously by state. But at the state level, we have different brackets for different income levels. And at the top side, we've got this really fun one at 9.85. So I bring it up just so that you think about it from the standpoint of making sure you add state in with federal. It's always surprising. People will ask me, especially with capital gains, well, my capital gains rate is going to be 15% or 20%. But when you do the math, oftentimes it's plus this number because in Minnesota, capital gains are basically your ordinary rates. And so we have to add that, and pretty soon the tax bills add up. So I bring all this up so that you can start to think about, well, within certain realms of income, what can I do? Now, I'm going to step away from income taxes for a second and jump into estate taxes because this gets into some other individual issues that will play into this. From a estate tax standpoint, currently on a per person basis, you can basically give away while living or at death 13.6 million. This gets moved up every year for inflation, so it will keep getting moved up a little bit. With that, this 13.6 is per person. So as a couple, if you think about it, you could do a little over 27 million, where you would have that 27 million completely outside of any estate tax. Now, the issue too that's interesting is at the federal level, there's portability of that exemption. What portability means is you can basically, if someone dies and doesn't use all their exemptions, so they're 13.6 million, their spouse can make an election to use it along with their own. So let's say you have one spouse that just has a huge 401k plan or something that's in their name that puts a lot on their side of the fence, whereas the other spouse might only have a few million on their side of the fence. Well, they can use it and basically add it up to still use the full 27 million. So I bring that up because portability is available at the federal level, but it isn't at the state of Minnesota level. So that's a different issue. Now with this, if you go over the 27 million, then we have tax rates that are running around 40%. So it does get rather expensive when you start thinking about estate taxes. And we do have another issue that's not a state tax issue. But when we get into deductions, we do have some other deductions on the income tax return that we'll worry about as I go along, where the standard deduction for joint filers actually gets increased for people over 65. So these numbers go up per person on top of this. And I bring it up just so that people understand that. I've had some confusion over the years where people say, well, I think the standard deduction is this, and now it's that. And it's, yeah, because your birthday pushed you over 65. So a couple of things to note. Now, one thing I'll also note as I go forward is that this estate tax exemption is in place, and we're going to do some webinars in May and June about this, but this estate tax exemption is in place through the end of 2025. And then it goes back down to what the rule was basically 10 years ago, plus inflation. So 10 years ago, the rule was 5 million. And if you add inflation on top of that, it's going to be around 7 million. So that's about where it'll be starting January 1st of 2026. I bring it up because we're going to get into a lot more on those webinars about what that means and how people that have larger estates today really do need to act fairly quickly. Now, getting back into that itemized deduction perspective, that 29,000 that everyone has as standard deduction. If you remember, the tax bill that was passed when President Trump first came into office didn't have enough votes to make it a permanent bill. So basically it expires after 10 years, which is what I just mentioned with the estate tax exemption. Well, that same 10-year rule applies to these itemized deductions. But for now, what's going on is that at the state and local level, when we talk about real estate taxes and our state income taxes, instead of being able to itemize them all the way up to what they used to be, what now occurs is they get capped at the 10,000. Also, mortgage interest deduction was capped now so that on the high side, you can take interest deduction on the first 750,000 of a loan. These were some changes that occurred. There was a grandfathering in, by the way, of some of this, but higher numbers. But for the most part, these changes did occur. And that's about it. I'm going to talk later in this presentation about charity. Charity is the one other way that you can actually affect things. But in general, that's what's going on. Now, one thing I'll just point out is home equity loans used to be very popular because everyone would say, well, I'll just deduct my home equity interest. And the reality of that is that also got changed. So there is this idea of acquisition indebtedness versus home equity indebtedness. Acquisition indebtedness is when you actually are doing something for fixing the physical home. So there are scenarios where you can write off interest if there's acquisition indebtedness on another loan. But if it's just a loan because you wanted to roll your car loan into it or something like that, those kinds of home equity loans are no longer deductible. Finally, I just want to jump on this charitable donation thing because we do see now the ability to give away more money if we are giving away cash. Cash is at this 60% number. So from our standpoint, there are some opportunities to do some interesting charitable things. I'm going to bring one of those up. By the way, if you give away appreciated securities, then it's only a 30% deduction off of AGI, not 60. So what I will encourage you to do all the time is make sure you have your accountant actually run that before you start giving away large chunks to charity, because there are occasions where those things can get a little in the gray zone where you can't deduct everything. Now, you can carry it forward and deduct it in future years, but sometimes people think they are getting this big tax help this year, and it doesn't always work out that way. Again, coming back to Minnesota for a quick slide so that we are just aware of what's going on. There is no gift tax when we talk about taxes at the estate level, or I'm sorry, the gift level. I bring that up because in 2024, at the federal level, you can gift up to $18,000 a person, 36,000 for a married filing jointly, and have no federal tax. But if you think about it, there is no gift tax. The rule with the gift tax in Minnesota is there's a 3-year rule on gifting where when gifts are made, if the person who made the gift, the donor or the grantor, doesn't die for 3 years, we're all good. If they die within 3 years, those gifts can get pulled back into their estate. I bring that up because sometimes when we're talking about gifting issues, and again, I'm going to get into this more in the webinars in May and June. But when we want to give, sometimes we'll say, let's give more than this 18,000 because we can use up some of our exemption at the federal level early, especially if we think it's going to expire in the end of next year, like we believe. And the beauty of that is that at the Minnesota level, there's no gift tax at all. So we can do those gifts within those federal rules. And again, as long as someone lives for 3 years, we're free of any kind of Minnesota connection. So I bring that up so that you can think about what kind of gifting you may want to do. Sometimes people just think of this $18,000 number and say, well, I got to keep it under that. The reality is, no, you don't. There's some really cool things we can do above that number if people want to give more generously to their kids and grandkids and really do it while they're still alive so they can see how much fun that money means to the rest of the family. The other thing is in Minnesota, the limits on per person are 3 million. And I bring this up so that you do understand that if you die with the money, this is what's interesting. If you die with the money, anything over 3 million per person basically is going to have a tax associated at the Minnesota level, which is 6 million per couple. But what you don't see on this slide is what I mentioned earlier about the federal number, which is there's no portability in Minnesota. So if someone dies and doesn't use up their full 3 million, their spouse can't use what was left over. Their spouse can only use the 3 million they have. You really want to make sure estates are balanced from an ownership perspective. Sometimes balancing could just mean that maybe the house shouldn't be jointly held. Maybe it should be held all in one person's name because the other person has a large IRA or something. Those are the kinds of issues you got to work out with your attorney, because I think in the long run, that's what's going to come into play for a lot of people is these $3 million limits. So keep that in mind as you move forward at the Minnesota level. Now, as I move forward, I just kind of want to summarize some of these ideas because I've thrown a bunch of things out. From a summary standpoint, if you think about capital gains, let's think about, can we harvest them inside of that 12% tax rate, income tax rate? Because when we do that, we pay 0% on capital gains. Secondly, can we in any way get income limits down or income brackets down for certain reasons? And so one of the ways we could do that is maximize contributions to anything tax sheltered. So maxing out 401k plans, maxing out traditional IRAs and potentially Roths, because long-term, what I'm going to point out with Roth IRAs, I'll talk about Roth 401k in a little bit, as well as HSAs, is that those dollars grow tax-free forever when used correctly. And so those dollars never come back to create tax problems. And so sometimes those things are more longer term thinking ideas, but that can actually have a big issue or big help on your tax return. Um, Third thing, maximize tax brackets. I mentioned this earlier, but this becomes a really key factor for people in decumulation mode. Accumulation's easy. We save as much as we can into 401k plans and brokerage accounts and stuff. We're working hard, we're earning income. It is what it is. But when you hit decumulation phase, which is usually around retirement, can be a few years earlier than that, that's when we have to start thinking about maximizing certain tax brackets because we need to look out several years and see where we're actually headed. If otherwise we get there and we're going to be locked into some potentially even higher brackets. To that point, we want to strategize about opportunities in low income years. I'm going to get into this in a few slides. We want to coordinate any extra income issues. So what we see oftentimes is people forget things like stock options, deferred comp, potentially payouts on a business sale that happen years later when certain things free up. And so what ends up happening is they forget that income pops in and it can create other problems. So I bring that up just to keep that in mind. I'm going to get into this one more in a slide or two, but this idea of giving away income generating or highly appreciated assets can be interesting. I think sometimes what ends up happening is we think as normal human beings that we want to create as much income as we can. And I think one of the old adages is you get to retirement and you live off your income. But what ends up happening sometimes is if you think about it from this perspective, the more income we make, the higher our tax bills. The more assets we have, not necessarily higher our tax bills. So what I think more people are seeing is that you want to build assets more than you necessarily want to build income. Now, when you look at it from that angle, gifting away income generating assets becomes interesting because you can turn around if you got other assets, sell them, pay lower taxes on potentially capital gains rates or even less, and still live just as fine. So this idea of income generating has shifted a lot over the years, especially with wealth managers. We tend to move away from that as you get closer to retirement because it's really more of a tax problem than anything. Finally, tax exempt bonds. I'm going to touch upon this in a second, again, because I think this is interesting. What we're seeing more and more is people are coming in with tax returns that have a lot of income on them. And I mentioned this already on the previous point. And they could lower their income a lot by simply using municipal bonds. And I don't think people understand what that does to a tax return. So let's go through a couple of interesting ideas as I move forward here. First off, let's say you have a lot of investments in a brokerage account. One of the biggest mistakes we see people make when they have investments is they don't analyze the potential income coming off those investments versus what happened in the market that year. So for example, oftentimes you buy something, you buy an investment. This happens more often early on, but this can actually really matter too in market downturns. You buy an investment 6 months into the year, and what you may not realize is, and this is unique to mutual funds, is that somewhere in December, there's going to be a dividend paid because that basically is going to pay out any capital gains or income that were derived inside of the mutual fund, but it's paid out to any shareholder, even if it wasn't you that created that capital gain. So somebody along the line that year said, well, I want to sell this mutual fund and get out of it. And in order to pay that person off, the mutual fund had to sell a stock, let's say, create capital gains. It's the people left holding that mutual fund that basically are going to pay that capital gains tax. So what we would like people to be thinking about more and more is look at it from the perspective of when we get near these ex-dividend dates, And the next dividend date is once you hold it past this date, you don't have a choice. You're going to take that income. But up until this point, you don't have to if you think that you don't want to. So what we'll do is we'll look at it and we'll say, well, let's pretend on a $100,000 market value and we bought it or mid-year, let's say, so we've spent 95,000 on this. So there's a $5,000 capital gain. We look at that and we say, the taxable income coming out is $3,000, let's pretend. So I can either take $3,000 or I can turn around and sell it and pay the tax on $5,000. So if you think about it, the tax due is $800 or $866. And then there could be some state tax on that too. So when I think about it from that angle, I might actually, and I have two different scenarios, but they're the same thing basically. If I think of it from that angle with different tax rates, it may make sense for me to take, sell the investment, even though I just bought it, and pay a higher tax rate because I end up paying more if I take the income. So this is a little counterintuitive, but I want people to be thinking about this idea of tax efficiency inside of their investment portfolios. I don't think people spend enough time in the at the end of the year looking at this stuff. Basically, you do have to look at it on an asset by asset basis, but looking at it and saying, do I have opportunity to avoid certain tax hits? Now, once this ex-dividend date goes by, it's too late. You're stuck. So I just bring that up. Second thing to consider is the idea of the Roth IRA. Now, the IRA is great because an IRA allows you to take a deduction for the contribution, similar to 401ks. If you have a 401k, you may not even qualify to get an IRA deduction. But on here, you'll see that there's also some income limits. And so when we look at IRAs, there's income limits for deductibility, whether you're single or married filing jointly. So let's do married filing jointly. Once you go above this 143, you can no longer deduct an IRA. Now you can still put money into an IRA because if you look at this, my fourth bullet point, non-deductible contributions are allowed. So above this 143, if you want to still do it, you can. It's just that you can't deduct that contribution. Now on the Roth IRA side, the difference is the contribution's not deductible, but on the back end, the withdrawal is tax-free. So we get to grow the money and eventually spend it tax-free. That's the beauty of it. Now, everyone says to me, well, why wouldn't I do a Roth? That makes the most sense. The issue here is that if you do the math, if you're in the exact same tax bracket, these are actually identical outcomes. Whether you paid the tax in the front end or the back end, you're going to have the same amount of money left over as long as you're in the same tax bracket. The issue that is an advantage is if your tax bracket's different. So if your tax bracket on an IRA is high today, and then you get into retirement and it drops, you're going to pay taxes on the distributions at a lower level. That's a good thing. But if your contributions go in today in a lower bracket and you anticipate your brackets being higher in retirement, then a Roth is a better answer. And so it just depends on those couple of things. So when we look at the Roth idea, there are some strategies that we'll talk about with Roths that are interesting to us. You can contribute to a Roth, although we find a lot of people don't quite qualify. So I'm going to look at this first section on how to contribute as a little less interesting because a lot of people can't. Now, we are seeing, because of the 401k world now offering Roths inside of 401ks, that's getting more interesting because people, if they're in lower brackets, can put in some fairly sizable chunks. So 23,000, which is the max per person that you can contribute. Plus, if you're over age 50, you can do these catch up. And as I mentioned, starting next year, there might be even more for certain people. So that's where it could get interesting. But what's interesting to us is also this idea of Roth conversions. So plenty of people are walking around with large 401k or IRAs. And in those scenarios, potentially pushing income into certain tax brackets and doing it with a Roth conversion is interesting. For those of you that don't understand that, a Roth conversion basically says I can convert money out of a regular IRA or a Roth IRA as long as I pay the tax right away. Now, the way to do this is to make sure you pay the tax out of other dollars. Don't pull the tax out of the IRA money that you just converted, because you'll lose the entire effect. The beauty of this is if you leave those dollars in and in effect let the Roth grow those extra dollars that would have gone to tax and basically compound upon each other, because that becomes all tax-free down the road. So you do want to have the tax payment come out of other dollars, your brokerage account, your cash savings, whatever. Okay. The second interesting idea behind this Roth, though, is this idea of a 401k conversion. And I'm going to skip to this third bullet point about mega backdoor Roth. Where this becomes interesting is you can convert now inside of a 401k to a Roth. And this mega backdoor Roth is the example I'm going to use. It's called mega backdoor because in essence, what you're doing is you're doing a regular backdoor Roth, which is 0.2. And a backdoor Roth is simple. You didn't qualify for the tax deduction. So you still made contributions to an IRA on an after-tax basis, and then took those after-tax contributions and converted them into a Roth. Since you didn't get a tax, since they weren't tax deductible going into the IRA and used after-tax contributions, converting into a Roth creates no tax. So there is an opportunity there, but that's on the smaller level because we're contributing $7,000 at a pop into these, IRAs that we convert to the backdoor Roth. In a mega backdoor Roth, what we're doing is we're doing this now at the 401k level. So we're doing these larger contribution numbers. But what's interesting is you can go above 23,000. Now, most people don't know this, but if you want to typically contribute past this, the employer plus employee number on an after age 50 basis is actually closer to, and I had to write this down, 76,500. So you could contribute regular 401k dollars, but then do after-tax 401k dollars on a much bigger dollar amount, and then convert the after-tax numbers into a Roth 401k. That's what we call the mega backdoor Roth. And so people could potentially convert huge dollars year after year after year. Now, the caveat to all this, always a caveat, is that most 401k plans don't allow it. So we are still seeing a lot of this come down to, did the 401k provider adopt these new provisions that are allowed? The IRS allows them, but if the 401k provider, your employer, doesn't allow them, can't do it. So you do need to make sure that the 401k plans have been amended to allow for this. We're still seeing a lot that it just doesn't work yet. And so if you're an employer, though, on this call, think about that as an opportunity for not only maybe you, but your employees. So these Roth ideas are kind of cool. And I kind of want to sum this up a little bit. I created this chart so you can see what's the best times in life to use a Roth. If you think about this, on the left-hand side are the different income tax brackets. And on the bottom, I just simply did a kind of an idea of different phases of life. So when you're a young adult, let's say you're in the 10 to 12% tax brackets, great times to use Roths in general. Then as you start to get up into these higher brackets and you get into this career advancement stage, probably slightly less advantageous time to use Roth. And then all of a sudden you quit, you're sick of corporate America, so you go start a business. Well, guess what? Maybe you are down at almost no income, but if you had a 401k back here, maybe you can convert some of that into a Roth. And since you're down here at no tax bill, maybe you don't even pay taxes on that conversion. I bring this up because I actually see this a lot where people have a tax year or two. And we saw this in 2008, especially where you had a lot of businesses struggling with the whole real estate debacle. And so you saw people literally go into negative income for a year or two. Well, those are perfect examples where they should convert IRA dollars or 401k dollars into Roths, because they may do it at no tax hit. And now they've basically for the rest of their life got tax-free money. So there could be some interesting ideas there. And you can see different times in life. What we're talking about today is probably this early retirement phase where people early on, if you push Social Security out till age 70, if you don't have to take those required minimum distributions until 73, there's an early phase of retirement potentially where we can be pretty strategic with some Roth conversions and get money out of these IRAs at a potentially lower hit. So I want you to think about that. And I'm going to expand on that a little bit. These required minimum distributions are issues that pop up all the time because people sometimes think about this in the here and now as opposed to what happens broader. Okay. So from an required minimum distribution standpoint, let's look at this as it stands. If your distributions at age 73 are mandated, if you had $1 million retirement account balance, this balance, by the way, is calculated on 12/31, December 31st of the previous year. So for 2024, we would look at your account balance in an IRA or a 401k on December 31st of 2023, and that's where we calculate the RMD. The distribution period, according to the IRS, 26.5. They think you're going to last another 26 and a half years. So if you do the math, million divided by 26.5 means that you have $37,000 you have to pull out in 2024 and pay taxes on it. Now, as a cheat sheet, this 26.5, if you do the math, it's about 3.5% of the account balance that you're always pulling. It goes up over the years slightly, but just think of it that way in your mind and you'll have this pretty close. So we know we've created income on 37. Okay. Now, one thing I'll point out is there could be some potential timing here that comes into play. A couple of warnings. We do see IRS life expectancy tables because that 26.5 I mentioned, there is a couple of tables based on certain things like if you inherit a Roth or something or inherit an IRA, you might have a slightly different table. So I bring it up because we've seen user errors where people will use the wrong life expectancy table and that can get them in trouble. So I just know that. Check with your accountant / institution. Most institutions these days will have a IRA distribution calculator. But in general, let's think about this from a timing standpoint. I'm going to change my language a little bit. No longer am I going to talk about this from the standpoint of just require minimum distributions, but a lot of people pull more than that out because they might need to do certain things within tax brackets. They might need it for spending or purchasing a new car or whatever. So let's pretend you're pulling 140,000 out of an IRA. In that scenario, what most people would do is they would just take the money. So let's do that in 2024. First 23,000 is taxed at 10%, 2,300 bucks. The next 70,000 or so is taxed at 12%, $8,500. And then the last of this amount is taxed at 22% or another 10 grand. Add that all up. We have $21,000 roughly of tax expense. However, if you know this is going to happen, if you think you know this is going to happen, even a day sooner than 2024, what you could have done is broken it up into 2 years and take 70,000 in 2023 at the end of December and the other 70,000 on January 2nd of 2024. You break up your tax rates. And what ends up happening, if you look at this, is you never pop up into this higher bracket and you save yourself $5,000 in tax. And this is where we see a lot of errors because people aren't paying attention to their brackets and where their distribution of income comes from. So I bring it up just because this is a pretty standard one. Now, I'm going to touch upon the 3.8% Medicare tax just because this confuses people. This is the tax that typically gets applied on top of modified adjusted gross income. A lot of people think of this as that Medicare tax that goes on top of capital gains. For the most part, here's the way the rule reads. You basically have to look at it from the standpoint of whether or not you hit these numbers. These numbers are not indexed for inflation. These numbers were put in place way back in 2010. So these are really old numbers, but that's what we live with. The other thing I want to point out, and this gets confusing, modified adjusted gross income is different than adjusted gross income. Whoops, I went the wrong direction there. Modified adjusted gross income, the word modified means that they add back certain things. So for example, you can add back municipal bond interest. And that's the kind of stuff that can get people in trouble sometimes. And it's just based on certain definition. So in this case, the word modified actually doesn't include municipal bond interest, but in another case, it actually can when you talk about some issues of Social Security. So I bring that up. In this case, investment income is interest, dividends, and capital gains, annuities, and rental income. But what's not investment income in this scenario is tax exempt muni bond interest and retirement account withdrawals or conversions. Now, wages are not, obviously. So this becomes interesting because sometimes people, if you think about it, you have to look at the makeup of your assets to decide if this gets triggered or not, and it becomes a game. So let me give you a couple of examples. Let's pretend Fred, single person, has $100,000 of salary, so we know that doesn't apply. 50,000 of investment income for a modified adjusted gross income of 150. Okay. In this case, the 3.8 doesn't apply because his adjusted Maggie is under 200. Okay. Now we take Tony and Tina from the famous Tony and Tina's wedding. If they're filing jointly, they have $300,000 of salary, 50,000 of IRA withdrawals, 50,000 of Roth conversions, but no investment income. This 3.8% also does not apply because they didn't have any investment income. All their income came off of stuff that doesn't count. However, in Scott and Sarah's standpoint, if they've got income plus investment income, the 3.8 does apply on that income, investment income that's over those limits. And furthermore, we don't think about trusts very often, but trusts are a big, big issue because trusts hit these numbers at much lower rates. So if you look at it from a trust perspective, anything over 15,200 is taxed with this 3.8. Now think about that, 15,000 versus 200 if you're single or 250 if you're married. It's a totally different game in trusts. And so trusts become a different problem. And I would just bring it up in case you do own a trust where you have this issue. Those kind of things should be addressed. Now, as I slowly get near the end, if you do have questions, please throw them in. I want to talk about a couple of quick things that should be addressed in general that are helpful. First of all, too many times on tax returns, we see taxable interest and dividends. And when we see that, our first thought is, can we use municipal bonds instead? Because that would give you a better answer. This point a few years ago was less interesting because when interest rates were at zero, it really was an issue. But today, this is actually more interesting. Currently, and when I say currently, we pulled this data as of February 19th. A certificate of deposit on a five-year CD was paying 4.25. Okay, on a tax-exempt muni, almost 3.5. Now, by rule, our brains we think about this and say, well, I want 4.25, I don't want 3.5. But then you do the tax calculation. If you're at the higher brackets, and that's what I've got in here, highest federal plus the 3.8 plus the state, Minnesota State at 9.85, you're actually paying a really high tax bracket. So the tax equivalent yield is you got to pay taxes on the CD. So you're actually clearing only 2.1. But since this is tax free, it would be like earning 6.85. Again, I'd rather have 6.85 than 2.1. So in that scenario, I'd rather shoot for municipal bonds. So as we move forward, especially as we get these higher rates, I think it's very, I think we should all be looking at our investment portfolios differently today than we did even a couple of years ago. Right now, we're all enamored with 5% cash yields on everything. But the reality is, after tax, that might not be working out for you. So, secondly, let's talk about charitable giving quick. Charitable giving is probably one of the best ways, if you have charitable intent, to give away appreciated assets and do so where you create some interesting tax opportunities on your tax return. In fact, if you pair charitable contributions with Roth conversions, sometimes you can actually convert more money in a Roth conversion because of this. So this all comes back to, do you have charitable intent? But let's think about this from the standpoint of, let's pretend you got stock that's worth 10,000 and you have a very low cost basis. So you know if you sell it, by the way, I got a typo here, not 2,000, 5,000, it's 2,500. So take a zero off. But on a stock sale, if I sold that and paid the tax and then gifted the money away, I wouldn't give away 10,000. I'd only give away 8,200. Okay, because I got to pay taxes first. If I'm in AMT issues, it could be more. But if I transfer in kind, so I give this $10,000 away, I don't have this capital gain hit. I can give away the full 10,000. So the best answer is, I want to give money if I can, not give it away, not in cash, but in appreciated stock of some sort, appreciated mutual funds, appreciated ETFs, appreciated real estate, you name it, anything appreciated. Now, where this gets interesting is, typically when people think about this, they're saying, I want to do this today. But what if I want to do it in the future? Well, I want to get the tax benefit today. So how do I do that and then give the money away down the road somewhere to charity? And the answer to that is, let's use donor advised funds. So in a donor advised fund, think of this as, a donor advised fund is basically like a brokerage account inside of a charity. So any big brokerage firm is going to have this probably, as is any community foundation or religious foundation. They all have donor advised funds. The beauty of these is when you put the money in, you get the tax deduction today, but you don't have to give the money away. So we can give it away over the next 5 years, 10 years, 20 years, 30 years, doesn't matter. If you die with money in there, you can basically say, hey, let my kids give it away on my behalf. So there are ways to, interestingly, create charitable giving education for your children. So from the standpoint of a donor advised fund, we love these things because it allows us to drive a tax answer today, particularly around Roth conversions and some of that, or sales of a business or something. Tax answer today, but the beauty of being able to give it away later. And later can oftentimes be just because you don't want to give it all to charity today. Like it could be too much money, or it could be that you're just not sure which charity to give it to. So in that scenario, if you just have charitable intent, that's the main question I want to understand. As an aside, just so you have a working framework, sometimes people will say, well, how much should I put in these things? And if you're really not sure, but you want to do something a little larger than normal, what we typically will do is look at someone's tax return and say, okay, typically you've been giving away $6,000 a year. Let's multiply that by 5. Let's give away the next 5 years this way. And so we'll do 6 times 5, and now it's 30 grand. Let's do a $30,000 contribution to this. And then we'll just not give to charity out of your normal cash for the next 5 years. We'll give to it out of the donor advised fund. What we found is most people become more generous once they start one of these, and they actually give it away faster and keep refunding these things. So it's been interesting to watch, but I do encourage you to look into this. These are really neat planning tools, but they also are really neat tools to help society. I had a question come up about gifting, by the way. Could I gift appreciated stock to my children while their income is low instead of just giving them cash? That's actually a really good question. And the answer is yes. Oftentimes, if you're to take away the word charity here, because I was just talking about charity, if you're giving away appreciated assets and you want to give them to kids or grandkids, um, oftentimes it's better to give away a stock or mutual fund with capital gains treatment to a kid who might pay anywhere from 0 to 15% maybe, but probably doesn't have to pay 20 and plus the extra 3.8 Medicare surcharge, that kind of stuff. So sometimes that's a great way to give away assets to your kids. I've seen it many times where people will say, I want to give away the full 18,000 per person this year, but do it with a stock or a mutual fund instead of cash. So great question. Thank you for asking that. We are going to close up here with a couple of quick slides. I'm not going to get into Social Security taxation too much. For the most part, what I see is if you have this issue, it's because of these income limits. We don't see a lot of people falling under these limits, so I'm not going to bring it up a lot, but I wanted the people to see that here's about what happens. If you go over 44,000 in married joint filing income, you're basically over 44 going to pay tax on 85% of your Social Security. There's not much you can do about it. Here's where I'll spend a minute before I wrap up. You know, Medicare premiums have become a real thorn in people's side. If you think about Medicare, it's a very cheap and very good insurance plan. The problem is if you go above certain income limits, they start tacking on more charges. So think of it this way: joint people below 206,000 just pay whatever Medicare costs for Part B and Part D. Okay, Part D is drug coverage. Part B is your standard Medicare coverage. Okay, so if you think about it, it's going to cost $174 per person per month. So joint couple, that's $4,000. Okay. If you go above 206 though, for that joint family, up to 258, they're going to tack on $12.90 more to Part D. And if you do this, I didn't do this in the same layout, but this 174 jumps to 244 for Part B. So if you do the math on these two additions, we're adding $2,000 of cost, which is in effect, if you do the math, almost a 50% increase. Okay. Now you go above 258 up to 322. It adds $33 more, plus more on top of this. And really it's a $5,000 hit. So now you're basically more than doubling what you could have. And it gets worse and worse. I bring this up because this is, for those of you that are in the know, this is what we refer to as IRMA, the famous IRMA. And when this happens, sometimes we got to look at Roth conversions and other income issues and make sure we understand that they fall under these levels, because sometimes you trip these other issues that you're not even thinking about because they're not on your tax return, but they do come off of your Social Security check. So I just want to bring this up because this can trip people up when it gets to the Medicare side. Closing with two business ideas. For those of you that work with BGM, you probably already know all this, but when the tax bill basically took away itemized deductions in some way by capping how much we could contribute to, or how much we can deduct for personal income taxes and real estate taxes at that $10,000 number. The state of Minnesota came back and came up with this PTE rule where it basically said an entity can pay tax, the Minnesota tax on behalf of the partners, as long as the entity pays it, it's excludable from income. So then you don't have to report it as federal income. And so you can save some tax dollars. That's available through December 31st of next year. I am surprised, but I have run into a few business owners that have not taken in this. So I would, if you're on this call and you have that issue, I would check into it. Again, if you've been working with BGM, we've been talking about this for many years. And finally, QBI, this came up recently, and I was a little surprised on this too. So I thought, well, I'll at least throw a slide in. I ran into I've seen one or two scenarios where people still aren't aware of this, where you can deduct the first 20% of income for certain pass-through entities. There's a bunch of rules around this. I got another slide on this, but I bring it up so that you at least ask about it, because what's interesting in this to me is that the income limitation for individuals and then married couples, but if you think about this from an individual standpoint, you could use this rule and deduct this income that's not taxable based on your personal taxable income. In a business, partners may not always know what's going on the other side, but there could be some partners that are making less versus other partners, and they may qualify for this. And so you might want to have a conversation with your accountant at that level to make sure that the partners that could potentially qualify aren't accidentally throwing an extra few dollars that disqualify them from this bigger benefit. So that's the only reason I want to bring that up quick. With that, if there are any other questions, you got 30 seconds. I want to thank you for attending today. Today was a full hour. I really pushed it just because we have a lot of things we like to talk about in the tax side. Next month, I'm going to get more into how to diversify wealth for business owners. So this is not just about investing. This is about some ideas about the business side and things that you can do inside the business too. So it might be interesting if you're a business owner on this call, or if you know business owners, let them know that this invite will be going out soon. With that, I don't see any further questions popping in. So I wish all of you a great rest of your day. And if you have any questions, feel free to respond to the email you'll get as a follow-up, or if you want to contact me directly, feel free to do so. Have yourself a great day. Bye-bye.